Most people enter the world of investing with excitement. They want quick money. They want fast success. They follow tips, trends, and headlines. And slowly, without realizing it, they start losing control. The truth is simple. Investing is not about excitement. It is about discipline. It is not about speed. It is about patience. Many people believe the stock market is a place to make quick profits, but in reality, it is a place where money moves from the impatient to the patient. This is where this book begins. It does not promise shortcuts. It does not offer tricks. Instead, it teaches a mindset, a way of thinking that protects you from mistakes. The intelligent investor is not someone with high intelligence. It is someone who controls emotions, someone who follows rules, someone who understands the difference between real investing and dangerous speculation. Because this is where everything changes. Before you learn how to invest, you must first understand what investing truly means. And that leads us to the most important starting point. What is the difference between investing and speculation? Let us begin. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. When most people enter the stock market, they believe they are investing. They open an account, buy a few stocks, and feel confident about their decisions. But in reality, many of them are not investing at all. They are speculating. This difference may sound small, but it changes everything. It decides whether you build wealth slowly and safely, or whether you lose money while chasing quick success. Investment is based on careful thinking. It is based on analysis, discipline, and long-term planning. Speculation is based on guessing. It is driven by emotion, excitement, and hope. An investment operation, according to Benjamin Graham, is one that promises safety of principal and a reasonable return. If an action does not meet these conditions, it is speculation. This definition is simple, but it is powerful. Safety of principal means you protect your money first. Before thinking about profit, you think about risk. You ask yourself, can I lose a large part of my capital here? If the answer is yes, then you are not investing. A reasonable return means you are not chasing unrealistic gains. You are not expecting to double your money quickly. You are satisfied with steady, consistent growth over time. Speculators think differently. They are attracted to fast profits. They follow hot tips. They buy stocks because others are buying. They sell because others are selling. They believe they can outsmart the market. They believe they can predict the future, but the market does not reward prediction. It rewards discipline. The biggest danger is not speculation itself. The real danger is thinking you are investing when you are actually speculating. This creates false confidence. It makes you take risks without understanding them. And when losses come, they come as a surprise. The intelligent investor accepts a simple truth. No one can consistently predict market movements. Prices can rise or fall for reasons that are impossible to know in advance. Because of this, the intelligent investor does not try to guess. He focuses on what he can control. He studies the business behind the stock. He looks at earnings, assets, and financial strength. He asks whether the price is reasonable compared to the value. This approach removes emotion. It replaces excitement with logic. Speculation, on the other hand, is full of emotion. It is driven by fear and greed. When prices rise, speculators feel greedy. They rush to buy more. They believe the trend will continue forever. When prices fall, they feel fear. They rush to sell. They believe the market will never recover. This cycle repeats again and again. The intelligent investor breaks this cycle. He understands that market prices are often irrational. They can move far above or far below real value. Instead of reacting to price changes, he uses them. When prices are low, he sees opportunity. When prices are high, he becomes cautious. He does not follow the crowd. He thinks independently. This mindset is what separates investors from speculators. Another important idea is expectations. Speculators expect quick results. They want fast profits. They measure success in days or weeks. Investors expect slow progress. They understand that wealth takes time to build. They measure success over years and decades. This difference in expectation changes behavior. When you expect quick results, you take more risk. You become impatient. You make emotional decisions. When you expect slow growth, you remain calm. You stay disciplined. You make better decisions. The intelligent investor also understands that losses are part of the journey. Even the best investments can decline in price. But a temporary decline is not a permanent loss. If the business remains strong, the value is still there. Speculators cannot handle this. They panic when prices fall. They sell at the worst possible time. Investors remain patient. They focus on value, not price. Another key difference is effort. Speculation often looks easy. It requires little thinking. You follow trends, listen to tips, and act quickly. Investing requires effort. You need to study. You need to think. You need to understand what you are buying. But this effort creates an advantage. Most people are not willing to do the work. They prefer shortcuts. The intelligent investor uses this to his benefit. By staying disciplined and patient, he avoids common mistakes. It is also important to understand that speculation is not always wrong. There is a place for it, but it must be controlled. If you choose to speculate, do it with a small portion of your money. Treat it like entertainment, not investment. Never risk your financial future on speculation. Keep the majority of your capital in safe, well-thought-out investments. This balance protects you. It allows you to participate in opportunities without exposing yourself to large losses. Another important lesson is humility. The intelligent investor does not believe he knows everything. He accepts uncertainty. He understands that mistakes will happen. This keeps him careful. It prevents overconfidence. Speculators often become overconfident after a few wins. They believe they have special skill. They increase their risk. Eventually, the market corrects them. The intelligent investor avoids this trap. He remains consistent. He follows rules instead of emotions. Over time, this consistency creates results. The results expected by the intelligent investor are not dramatic. They are steady and reliable. He does not aim to beat the market every year. He aims to avoid large losses. By protecting capital and earning reasonable returns, he allows compounding to work. Compounding is powerful. Small gains, repeated over time, become large wealth. But this only works if you avoid major losses. A single large loss can destroy years of progress. That is why safety comes first. The intelligent investor understands this deeply. He does not chase the highest return. He chooses the safest path to acceptable returns. This may seem boring, but it is effective. In the long run, boring strategies often win. Exciting strategies often fail. This chapter teaches the foundation of everything that follows. Before choosing stocks, before building a portfolio, before making any decision, you must understand this one idea. Are you investing or are you speculating? This question should guide every action you take in the market. If you answer it honestly, you will avoid many mistakes. If you ignore it, you will repeat the same errors that most people make. The journey of the intelligent investor begins here. With clarity, with discipline, with a clear understanding of what investing truly means. Because once you understand this difference, you are no longer following the crowd. You are thinking independently. And that is the first step toward real, lasting wealth. In Chapter 2. The Investor and Inflation. Inflation is a silent force. It does not make noise. It does not create panic immediately, but over time, it quietly reduces the value of your money. Most people do not notice it day by day, but year after year, its impact becomes powerful. If you keep your money in cash, it may feel safe. The number in your account does not change much, but what that money can buy slowly decreases. This is the hidden danger. You may feel you are not losing money, but in reality, your purchasing power is shrinking. The intelligent investor understands this clearly. He knows that doing nothing is also a risk. Inflation means that money must grow just to maintain its value. If your returns are lower than inflation, you are effectively losing wealth. This is why investing becomes necessary. But the question is not just about investing. It is about how to invest in a world where prices keep rising. In the past, many people believed bonds were completely safe. They provided fixed income and stability. They were seen as a reliable choice. But inflation changes this picture. When inflation rises, the fixed income from bonds loses value. The interest you receive may not keep up with rising prices. This means your real return becomes smaller. For example, if you earn a certain return but inflation is close to that level, your real gain is very limited. And if inflation is higher, you are losing in real terms. This is why relying only on fixed income investments can be risky over time. The intelligent investor looks for balance. Stocks, or ownership in businesses, offer a different advantage. Companies can increase prices as inflation rises. Their earnings can grow with time. This allows stocks to provide some protection against inflation. But this does not mean stocks are always safe. Stock prices can fluctuate. They can go up and down in the short term. Inflation can also affect companies in different ways. Some businesses may struggle with rising costs. Others may benefit from higher prices. This is why careful selection is important. The intelligent investor does not rely on one type of asset. He builds a balanced portfolio. He combines stocks and bonds in a way that reduces risk. This balance helps him handle different economic conditions. When inflation rises, stocks may perform better. When markets become uncertain, bonds may provide stability. This balance creates strength. Another important point is expectations. Many investors try to predict inflation. They try to guess when it will rise or fall. But this is very difficult. Economic conditions change for many reasons. No one can predict them with certainty. The intelligent investor accepts this uncertainty. Instead of trying to predict, he prepares. He builds a portfolio that can survive different situations. This approach reduces stress. It removes the need to constantly react to news. Inflation also affects behavior. When prices rise quickly, people feel pressure. They rush to invest. They chase returns. This often leads to poor decisions. The intelligent investor stays calm. He does not let inflation push him into risky actions. He follows his plan. Another danger of inflation is illusion. When prices and earnings rise, it may look like companies are growing fast. But sometimes this growth is only due to inflation. The real value may not be increasing as much as it appears. This is why it is important to look deeper. Focus on real growth, not just rising numbers. The intelligent investor always thinks in real terms. He asks, is this investment truly growing in value? Or is it just keeping up with inflation? This question helps him make better decisions. Inflation also affects interest rates. When inflation rises, interest rates often increase. This can impact both bonds and stocks. Bond prices may fall when interest rates rise. Stocks may also face pressure due to higher costs. This shows that inflation influences the entire market. Because of this, diversification becomes even more important. By spreading investments across different assets, the investor reduces risk. No single factor can destroy his portfolio. Another key idea is long-term thinking. Inflation is a long-term force. Its effects are seen over years, not days. Short-term market movements may seem important, but over time, inflation plays a bigger role. The intelligent investor focuses on the long term. He does not react to every small change. He understands that patience is essential. Over long periods, good businesses tend to grow. They adapt to inflation. They increase earnings. This growth helps investors maintain and increase their purchasing power, but this only works if you stay invested. If you keep moving in and out of the market, you may miss this growth. The intelligent investor avoids unnecessary actions. He stays consistent. Another important lesson is discipline. Inflation can create fear. It can make people feel uncertain about the future, but fear often leads to poor decisions. The intelligent investor controls his emotions. He follows principles instead of reacting to fear. He understands that inflation is not new. It has existed throughout history. Markets have faced it before, and they will face it again. By learning from the past, he gains confidence. He knows that well-managed companies can survive and grow. He also knows that no investment is perfect. Stocks can fall. Bonds can lose value. But a balanced approach reduces these risks. The goal is not perfection. The goal is resilience. A strong portfolio can handle inflation without collapsing. This is what the intelligent investor aims for. He does not chase the highest return. He builds a system that works over time. Inflation also reminds us of an important truth. Money is not valuable by itself. Its value comes from what it can buy. If prices rise, money loses power. This is why investing is essential. It allows your money to grow along with the economy. Without investing, you are slowly falling behind. With intelligent investing, you can stay ahead. The key is not to fear inflation. The key is to understand it. Once you understand it, you can prepare for it. You can build a strategy that protects you. This chapter teaches a simple but powerful lesson. Do not ignore inflation. Do not underestimate it, but also do not let it control your decisions. Stay balanced. Stay disciplined. Think long-term. Because in the end, successful investing is not about avoiding every risk. It is about managing risk wisely. And inflation is one of the most important risks you will ever face. Understanding it is a step toward becoming a truly intelligent investor. Chapter 3. A Century of Stock Market History, the Level of Stock Prices in Early 1972. To become a successful investor, you must understand the past. The stock market does not move randomly. It follows patterns that repeat over time. History does not repeat exactly, but it often moves in similar ways. This is why studying market history is so important. Over the last 100 years, the market has gone through many cycles. There have been times of great optimism. There have been times of deep fear. Prices have risen to extreme highs, and they have fallen to painful lows. The intelligent investor studies these patterns. He learns that no condition lasts forever. There were periods when people believed stocks could only go up. They felt confident. They invested heavily. Then came sudden declines. Prices dropped sharply. Confidence disappeared. This cycle has happened again and again. One of the biggest lessons from history is this. The market is driven by human emotions. When people feel greedy, prices rise beyond real value. When people feel fearful, prices fall below real value. These emotional extremes create opportunities. The intelligent investor does not get carried away by emotions. He observes them. He uses them to his advantage. Another important lesson is valuation. Stock prices are not always connected to true business value. Sometimes they are too high. Sometimes they are too low. In periods of optimism, investors pay high prices. They expect strong growth. They ignore risks. In periods of pessimism, investors avoid stocks. They expect losses. They ignore opportunities. The intelligent investor stays balanced. He does not buy just because prices are rising. He does not sell just because prices are falling. He focuses on value. The history of the market shows that extreme conditions do not last. High valuations eventually come down. Low valuations eventually recover. This does not happen quickly. It takes time, but it always happens. This is why patience is essential. Another key idea from history is unpredictability. No one can consistently predict market movements. Even experts make mistakes. There have been times when the future looked certain, but the market moved in the opposite direction. This teaches an important lesson. Do not rely on predictions. The intelligent investor does not try to guess the future. He prepares for different possibilities. He builds a portfolio that can survive uncertainty. Another important concept is long-term growth. Despite many declines, the market has grown over time. Businesses have expanded. Economies have developed. This growth has rewarded patient investors. Those who stayed invested over long periods have generally benefited. But this does not mean the journey is smooth. There are periods of decline. There are years when returns are low or negative. The intelligent investor accepts this reality. He does not expect constant gains. He understands that fluctuations are normal. Another lesson from history is the danger of extremes. When prices reach very high levels, risk increases. Future returns become lower. When prices are very low, risk decreases. Future returns become higher. This is opposite to what most people believe. Most investors buy when prices are high. They feel safe because everyone is buying. Most investors sell when prices are low. They feel afraid because everyone is selling. The intelligent investor does the opposite. He becomes cautious when prices are high. He becomes interested when prices are low. This approach requires discipline. It is not easy to go against the crowd, but history shows that this is the correct path. Another important idea is market levels. At different times, the overall level of stock prices changes. Sometimes the market is cheap. Sometimes it is expensive. These levels affect future returns. When you buy at low levels, your chances of good returns increase. When you buy at high levels, your chances decrease. This does not mean you should try to time the market perfectly. Timing the market is very difficult. Instead, you should be aware of general conditions. You should adjust your expectations accordingly. If the market is expensive, be cautious. If the market is cheap, be more optimistic. Another lesson is diversification. History shows that not all companies perform the same. Some succeed, some fail. By diversifying, you reduce the impact of failures. You increase the stability of your portfolio. The intelligent investor spreads his investments. He does not depend on a single company. Another important point is learning from mistakes. History is full of examples of poor decisions. People buying at the top, people selling at the bottom. These mistakes are repeated in every generation. The intelligent investor learns from them. He avoids repeating them. He understands that emotions are the biggest enemy. Fear and greed can lead to bad decisions. By staying calm and disciplined, he avoids these traps. Another key idea is realism. The market is not a place for easy money. It requires patience. It requires understanding. Quick profits are rare and unpredictable. Long-term success comes from consistency. The intelligent investor sets realistic expectations. He does not expect to become rich overnight. He focuses on steady progress. Another lesson from history is resilience. Markets recover from declines. Economies rebuild. Even after major crises, recovery has occurred. This does not mean every company survives. But overall, the system continues to grow. This gives confidence to long-term investors. It shows that patience is rewarded. Another important concept is discipline during extremes. During strong bull markets, it is easy to become overconfident. During bear markets, it is easy to become fearful. The intelligent investor remains steady in both situations. He does not get carried away by success. He does not panic during losses. This stability is his strength. The study of 100 years of market history teaches one clear lesson. The market changes constantly, but human behavior does not. Fear and greed continue to drive decisions. This creates opportunities for those who remain rational. The intelligent investor uses history as a guide. He understands patterns. He recognizes extremes. He does not follow the crowd blindly. Instead, he follows principles that have stood the test of time. This chapter builds a deeper understanding. It shows that investing is not about guessing the future. It is about understanding the past. It is about recognizing patterns. It is about staying disciplined in a world full of emotion. Because when you understand history, you gain perspective, and with perspective, you gain control. That control is what allows the intelligent investor to make better decisions. And over time, better decisions lead to better results. Chapter 4. General Portfolio Policy, the Defensive Investor. After understanding the difference between investing and speculation and learning from history, the next step is building a clear plan. This plan is called a portfolio policy. A portfolio is simply the way you divide your money into different investments. It is your personal system. It decides how much you invest, where you invest, and how you manage risk. Without a clear policy, you will react to emotions. You will buy when you feel excited. You will sell when you feel afraid. This leads to poor results. The intelligent investor avoids this by creating a simple and disciplined approach. This chapter focuses on the defensive investor. A defensive investor is someone who wants safety, simplicity, and peace of mind. He does not want to spend too much time studying the market. He does not want to take high risks. His goal is not to achieve the highest possible return. His goal is to avoid serious losses and earn steady growth over time. This approach may seem conservative, but it is very effective for most people. The defensive investor follows a clear rule. He divides his money between stocks and bonds. Stocks represent ownership in businesses. They offer growth potential. Bonds represent lending money. They offer stability and income. By combining both, the investor creates balance. This balance is the foundation of a strong portfolio. A common guideline is to keep a portion in stocks and a portion in bonds. The exact ratio can change based on personal preference. But one important rule remains. Never put everything into one type of investment. This reduces risk. If stocks decline, bonds may provide stability. If bonds perform poorly, stocks may provide growth. This balance protects the investor from extreme outcomes. Another important idea is flexibility within limits. The defensive investor may adjust his allocation slightly. When stock prices are very high, he may reduce his stock portion. When stock prices are low, he may increase it. But these changes should be moderate. They should not be extreme. The goal is not to predict the market. The goal is to maintain balance. This approach reduces emotional decisions. Instead of reacting to every market movement, the investor follows a plan. Another key principle is simplicity. The defensive investor does not try to select complicated investments. He avoids complex strategies. He chooses straightforward options. For stocks, he selects large, well-established companies. Companies with a strong history and stable performance. For bonds, he chooses high-quality and reliable instruments. This simplicity reduces mistakes. Complexity often creates confusion. Confusion leads to poor decisions. The intelligent investor understands that simple strategies often work best. Another important concept is diversification. The defensive investor spreads his investments across many companies. He does not depend on a single stock. Even strong companies can face unexpected problems. By diversifying, the investor reduces the impact of any one failure. This creates stability. Diversification does not eliminate risk completely, but it reduces it significantly. Another key idea is consistency. The defensive investor follows his policy over time. He does not change it frequently. He avoids reacting to short-term news. He avoids chasing trends. This consistency allows compounding to work. Compounding requires time. Frequent changes interrupt this process. The intelligent investor remains steady. Another important lesson is emotional control. Markets can be unpredictable. Prices can rise quickly. Prices can fall suddenly. These movements can create strong emotions. Excitement during rising markets. Fear during falling markets. The defensive investor controls these emotions. He does not buy more just because prices are rising. He does not sell everything just because prices are falling. He follows his plan. This discipline protects him from common mistakes. Another key concept is realistic expectations. The defensive investor does not expect extraordinary returns. He understands that higher returns usually come with higher risk. He is satisfied with reasonable growth. This mindset reduces pressure. He does not feel the need to take unnecessary risks. He focuses on long-term success. Another important point is maintenance. A portfolio is not something you create once and forget completely. It requires occasional review. Over time, market movements can change the balance. For example, if stocks perform well, they may become a larger part of the portfolio. If bonds perform better, they may increase in proportion. This can disturb the original balance. The defensive investor corrects this through rebalancing. He brings the portfolio back to its original allocation. This process keeps risk under control. It also encourages buying low and selling high. When stocks rise too much, he sells some. When stocks fall, he buys more. This happens naturally through rebalancing. Another important idea is avoiding extremes. The defensive investor does not put all money into stocks. He does not put all money into bonds. Extreme positions increase risk. Balance reduces risk. This simple idea is very powerful. Another lesson is independence. The defensive investor does not follow the crowd. He does not change his strategy based on popular opinion. He trusts his plan. This independence protects him from market noise. Another key concept is protection first, growth second. The intelligent investor focuses on protecting capital. Once protection is ensured, growth follows naturally. Many people do the opposite. They chase growth first. They ignore risk. This often leads to losses. The defensive investor avoids this mistake. He builds a strong foundation. Another important idea is patience. Results do not come immediately. There may be periods of slow growth. There may be periods of decline. The defensive investor accepts this. He understands that investing is a long-term journey. Patience allows him to stay consistent. Consistency leads to success. This chapter teaches a simple but powerful system. Create a balanced portfolio. Keep it simple. Stay disciplined. Avoid emotional decisions. Focus on long-term results. The defensive investor may not achieve the highest returns, but he avoids the biggest mistakes. And in investing, avoiding big mistakes is often more important than achieving big wins. This approach creates stability. It creates confidence. It allows the investor to sleep peacefully at night because he knows his money is managed with care. This is the true goal of the defensive investor. Not excitement, not quick success, but steady, reliable progress over time. And this steady progress is what builds lasting wealth. Chapter 5. The defensive investor and common stocks. After building a balanced portfolio policy, the next step is understanding how the defensive investor should choose stocks. Stocks represent ownership in real businesses. When you buy a stock, you are not just buying a price on a screen. You are buying a part of a company. This simple idea is very important. The defensive investor does not treat stocks like trading objects. He treats them as long-term ownership. This changes how he makes decisions. Instead of asking, "Will the price go up soon?" he asks, "Is this a strong and reliable business?" This mindset creates stability. The defensive investor follows a careful and disciplined approach when selecting stocks. He does not chase excitement. He does not follow trends. He looks for quality. The first rule is to choose large, well-established companies. These companies have a long history of operation. They have proven their ability to survive different economic conditions. They are not new or uncertain. This reduces risk. Smaller or newer companies may offer high growth, but they also carry higher uncertainty. The defensive investor avoids unnecessary risk. The second rule is financial strength. A company should have a strong financial position. It should not have excessive debt. It should have enough resources to handle difficult times. Financial strength acts as a safety cushion. In times of economic trouble, weak companies struggle. Strong companies survive. The defensive investor focuses on survival first. The third rule is stability of earnings. The company should show consistent performance over many years. This consistency indicates reliability. Companies with unstable earnings are more unpredictable. The defensive investor prefers steady growth over uncertain spikes. The fourth rule is dividend record. A good company often pays regular dividends. This shows that it generates real profits. Dividends also provide income to the investor. They are a sign of financial health. The defensive investor values this stability. The fifth rule is moderate growth. The company should show reasonable growth over time. It does not need to grow rapidly. Slow and steady growth is more reliable. Rapid growth often attracts attention, but it can also bring risk. The defensive investor avoids extreme expectations. The sixth rule is reasonable price. Even a good company can be a bad investment if the price is too high. Price matters. The investor should avoid overpaying. When prices are too high, future returns become lower. When prices are reasonable, the chances of good returns increase. This is where discipline becomes important. The defensive investor does not buy just because a company is popular. He checks whether the price makes sense. Another important concept is diversification. The defensive investor does not put all his money into a few stocks. He spreads his investment across many companies. This reduces risk. If one company performs poorly, others can balance the loss. Diversification creates stability. The investor may hold a number of different stocks, each representing a strong and reliable company. This creates a solid foundation. Another key idea is avoiding speculation. Many stocks attract attention because of stories, new technology, rapid growth, market excitement. But these factors can be misleading. The defensive investor focuses on facts, not stories. He avoids companies that depend on uncertain future expectations. He chooses companies with proven performance. Another important lesson is patience. Good stocks may not rise quickly. There may be periods when prices remain flat. This is normal. The defensive investor does not become impatient. He understands that value takes time to be recognized. Over the long term, strong companies tend to perform well. Patience allows him to benefit from this. Another key point is avoiding frequent changes. The defensive investor does not constantly buy and sell stocks. Frequent trading increases risk and costs. It also leads to emotional decisions. Instead, he holds his investments for the long term. He makes changes only when necessary. This approach reduces mistakes. Another important idea is independence. The defensive investor does not follow the crowd. He does not buy stocks just because others are buying. He does not sell just because others are selling. He follows his own rules. This protects him from market noise. Another concept is understanding limitations. The defensive investor knows that he cannot analyze everything in detail, so he focuses on simple and clear criteria. This keeps his decisions practical. He does not try to be perfect. He tries to be reasonable. Another key lesson is safety first. Every decision should consider risk. The goal is not to maximize returns at any cost. The goal is to protect capital while achieving steady growth. This mindset creates long-term success. Another important point is emotional control. Stock prices can fluctuate. Even strong companies can see temporary declines. The defensive investor does not panic. He understands that price and value are not always the same. He focuses on the business, not daily price movements. This keeps him calm. Another idea is long-term thinking. Stocks are not short-term tools. They are long-term investments. The defensive investor gives his investments time to grow. He does not expect immediate results. This patience allows compounding to work. Another lesson is avoiding extremes. Do not concentrate too much in one sector. Do not rely on one idea. Balance is important. The defensive investor spreads his risk. This creates stability across different conditions. Another key concept is trust in process. The defensive investor follows a proven method. He does not change it based on short-term results. He trusts that over time, discipline will bring success. This trust reduces stress. Another important idea is simplicity. The defensive investor does not need complex strategies. He needs clear rules. Choose strong companies. Pay reasonable prices. Diversify. Stay patient. These simple steps are powerful. This chapter shows that stock selection does not need to be complicated. It requires discipline more than intelligence. It requires patience more than speed. The defensive investor does not try to beat the market. He tries to avoid mistakes, and by avoiding mistakes, he achieves good results over time. This approach may not be exciting, but it is effective. It builds confidence. It reduces stress. It creates a steady path toward wealth. Because in the end, successful investing is not about finding the perfect stock. It is about following a sound process. And this process, when applied consistently, leads to long-term success. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Not all investors are the same. Some prefer safety and simplicity. Others are willing to put in more effort to achieve better results. These investors are called enterprising investors. They are active. They are curious. They are ready to study and analyze, but with this effort comes responsibility. The enterprising investor must be more careful, because more activity can also lead to more mistakes. This chapter focuses on the negative approach. The negative approach does not mean being pessimistic. It means knowing what to avoid. In investing, avoiding mistakes is more important than finding perfect opportunities. The first rule is to avoid poor quality companies. Some companies look attractive because of low prices, but low price does not mean good value. A company may be cheap for a reason. It may have weak finances. It may have declining business. It may have poor management. The enterprising investor avoids such companies. He does not get attracted to low prices alone. He looks for strength, not weakness. The second rule is to avoid overpaying. Even strong companies can become risky if bought at very high prices. When prices are too high, expectations are also high. If the company fails to meet these expectations, the price can fall sharply. The enterprising investor avoids this trap. He does not chase popularity. He waits for reasonable prices. The third rule is to avoid complex situations. Some investments are difficult to understand. They may involve complicated financial structures, unclear business models, or uncertain future outcomes. If you do not understand something clearly, it is better to avoid it. The enterprising investor focuses on clarity. He chooses investments he can understand. The fourth rule is to avoid frequent trading. Activity may feel productive, but it often leads to poor results. Frequent buying and selling increases costs. It also increases emotional decisions. The enterprising investor acts only when necessary. He does not trade for excitement. The fifth rule is to avoid following the crowd. Markets are influenced by public opinion. When everyone is buying, prices rise. When everyone is selling, prices fall. But the crowd is often wrong at extremes. The enterprising investor thinks independently. He does not follow trends blindly. The sixth rule is to avoid emotional decisions. Fear and greed are powerful forces. They can push investors to act irrationally. Buying during excitement, selling during panic. These actions lead to losses. The enterprising investor controls his emotions. He follows logic instead of feelings. The seventh rule is to avoid unreliable information. Many sources provide advice, news, opinions, predictions, but not all information is useful. Some is misleading. Some is based on speculation. The enterprising investor relies on facts. He studies real data. He verifies information. The eighth rule is to avoid unrealistic expectations. Some investors expect quick success. They want high returns in a short time. This mindset leads to risk-taking. The enterprising investor remains realistic. He understands that good results take time. The ninth rule is to avoid neglecting risk. Every investment carries risk. Ignoring risk is dangerous. The enterprising investor always asks, "What can go wrong here?" He prepares for uncertainty. The 10th rule is to avoid lack of discipline. Without discipline, even good strategies fail. The enterprising investor follows a clear process. He does not change it based on short-term results. Consistency is his strength. Another important idea is self-awareness. The enterprising investor knows his limits. He understands what he can do well. He avoids areas where he lacks knowledge. This reduces mistakes. Another key concept is patience. Opportunities do not appear every day. Sometimes the best action is to wait. Waiting requires discipline, but it prevents poor decisions. Another lesson is simplicity within effort. Even though the enterprising investor works harder, he does not complicate things unnecessarily. He focuses on clear and logical analysis. He avoids unnecessary complexity. Another important idea is learning from mistakes. Mistakes are part of investing. But repeating the same mistakes is dangerous. The enterprising investor reflects on his decisions. He improves over time. Another key point is independence of thought. The enterprising investor develops his own judgment. He does not rely completely on others. He listens, but he decides independently. Another concept is long-term focus. Even though the enterprising investor is active, he does not think short-term. He looks for long-term value. This keeps his strategy grounded. Another important lesson is avoiding extremes. Do not take excessive risk. Do not become overly cautious. Balance is important. The enterprising investor manages this balance carefully. Another idea is discipline in opportunity selection. Not every opportunity is worth taking. The enterprising investor chooses carefully. He focuses on quality opportunities. Another key concept is risk control. Before thinking about returns, he thinks about risk. This protects his capital. Another lesson is consistency. The enterprising investor follows a structured approach. He does not act randomly. This consistency improves results over time. This chapter teaches a powerful principle. Success in investing is not only about what you do, it is also about what you avoid. Avoiding mistakes creates a strong foundation. It reduces losses. It increases stability. This prepares the investor for better opportunities. The negative approach acts like a filter. It removes poor choices. What remains are better options. This improves decision-making. The enterprising investor uses this approach to protect himself. Because in investing, protection is the first step. Only after avoiding mistakes can you focus on finding opportunities. This leads to the next step. Once you know what to avoid, you can begin to focus on what to choose. And that is where the positive approach begins. Chapter 7. Portfolio Policy for the Enterprising Investor. Positive Approach. After learning what to avoid, the enterprising investor moves to the next step. He begins to search for real opportunities. This is called the positive approach. The negative approach protects you from mistakes. The positive approach helps you grow your wealth. But this requires effort. It requires patience. It requires clear thinking. The enterprising investor is willing to do this work. He does not depend on luck. He depends on analysis and discipline. The first idea in the positive approach is value. The investor looks for situations where price is lower than value. This difference creates opportunity. If you can buy something for less than what it is worth, you increase your chances of success. This concept is simple, but applying it requires effort. You need to understand the business. You need to study its financial condition. The enterprising investor does not rely on surface information. He goes deeper. He studies earnings. He studies assets. He studies long-term performance. This gives him a clearer picture. Another important idea is overlooked opportunities. The market does not always pay attention to every company. Some companies are ignored. They may not be popular. They may not be in the news, but they may have strong fundamentals. The enterprising investor searches for these opportunities. He looks where others are not looking. This gives him an advantage. Another key concept is buying in difficult situations. Sometimes good companies face temporary problems. Their stock prices may fall, the market may react negatively, but the underlying business may still be strong. The enterprising investor studies such situations carefully. If the problem is temporary, it may create an opportunity. But this requires judgment. Not every decline is temporary. Some companies have real and lasting problems. The investor must be able to tell the difference. Another important idea is special situations. There are times when unique events create opportunities. Changes in management, restructuring, corporate actions. These situations may lead to mispricing. The enterprising investor studies them carefully. He looks for situations where the market has not fully understood the impact. Another concept is patience in buying. The enterprising investor does not rush. He waits for the right price. Even if he likes a company, he does not buy at any price. He waits for a margin of safety. This patience improves results. Another key idea is diversification with purpose. The enterprising investor does not buy randomly. He selects a group of investments carefully. Each investment has a reason. This creates a focused portfolio. At the same time, he avoids putting too much into one idea. Balance remains important. Another important lesson is discipline in selling. Buying is important, but selling is also important. The enterprising investor sells when the price reaches fair value. He does not hold blindly. He also sells when his original reasoning is no longer valid. This keeps his portfolio strong. Another key concept is independence of thinking. The enterprising investor does not follow popular opinion. He forms his own judgment. This allows him to act differently from the crowd. This difference creates opportunity. Another idea is continuous learning. Markets change. Businesses evolve. The enterprising investor keeps learning. He improves his understanding. This helps him make better decisions over time. Another important concept is risk awareness. Even in opportunities, risk exists. The enterprising investor always considers downside risk. He does not assume everything will go right. This protects him from large losses. Another key lesson is emotional control. Opportunities often appear during uncertain times. When others are fearful, prices may be low. But fear can prevent action. The enterprising investor controls his emotions. He acts based on analysis, not fear. Another idea is long-term perspective. Even though the enterprising investor is active, he does not think short-term. He focuses on long-term value. This keeps his strategy stable. Another important point is effort and reward. Higher returns require more effort. The enterprising investor accepts this. He is willing to study and analyze, but he also knows that effort does not guarantee success. Discipline and judgment are equally important. Another key concept is selectivity. The enterprising investor does not invest in everything. He chooses carefully. He focuses on the best opportunities. This improves overall results. Another lesson is avoiding overconfidence. Success can create confidence, but too much confidence can lead to mistakes. The enterprising investor remains humble. He understands that the market is unpredictable. Another idea is consistency of process. The enterprising investor follows a structured approach. He does not change his method frequently. This consistency creates reliability. Another important concept is timing with patience. The investor does not try to predict exact market movements. He focuses on value and waits for the right conditions. This reduces the pressure of perfect timing. Another key lesson is focusing on facts. Opinions can be misleading. The enterprising investor relies on data and analysis. This improves decision-making. Another idea is balancing optimism and caution. The enterprising investor looks for opportunities, but he remains cautious. This balance protects him from extreme decisions. This chapter shows that successful investing is not only about avoiding mistakes, it is also about finding opportunities with discipline. The positive approach requires effort. It requires thinking, but it creates the possibility of higher returns. The enterprising investor follows both approaches. He avoids poor choices. He selects good opportunities. This combination creates strength because in the end, investing is a balance between caution and action, between patience and effort. The intelligent investor understands this balance, and by maintaining it, he moves closer to long-term success. Chapter 8. The Investor and Market Fluctuations. The stock market changes every day. Prices rise, prices fall. These movements are called market fluctuations. For many people, these fluctuations create confusion, they create fear, they create excitement. But for the intelligent investor, they create opportunity. The key idea of this chapter is simple. The market is there to serve you, not to guide you. This idea is often explained through a simple example. Imagine you have a business partner. Every day he offers to buy your share or sell his share. Some days he is very optimistic. He offers a very high price. Other days he is very pessimistic. He offers a very low price. His mood changes frequently. This partner represents the market. You do not have to agree with him every day. You can ignore him when his prices do not make sense. You can act only when his offer is favorable. This is how the intelligent investor treats the market. He does not follow it. He uses it. Most investors do the opposite. They let the market guide their decisions. When prices rise, they feel confident. They buy more. When prices fall, they feel afraid. They sell. This behavior leads to poor results. The intelligent investor understands that price and value are not the same. A stock may be priced high but not be valuable. A stock may be priced low but be very valuable. Market fluctuations create these differences. This creates opportunity. When prices fall below value, it is a chance to buy. When prices rise above value, it is a chance to be cautious. But this requires discipline. Because emotions often push investors in the wrong direction. Fear during declines, greed during rises. The intelligent investor controls these emotions. He focuses on value, not price. Another important idea is independence. The investor does not depend on market movements to make decisions. He has his own standards. He decides based on analysis. This independence gives him strength. Another key concept is patience. Opportunities do not appear every day. Sometimes the market offers fair prices. In such cases, the best action may be no action. The intelligent investor is comfortable waiting. He does not feel the need to act constantly. Another important lesson is avoiding panic. Market declines can be frightening. Prices can fall quickly. News can become negative. But these moments are often temporary. The intelligent investor remains calm. He understands that declines are part of the market. They are not permanent. He does not sell just because prices fall. He evaluates the situation carefully. If the value remains strong, there is no reason to panic. Another idea is avoiding overconfidence during rising markets. When prices rise continuously, it creates excitement. Investors feel confident. They believe the trend will continue. This can lead to risky behavior. The intelligent investor remains cautious. He understands that rising prices can create overvaluation. He does not assume that growth will continue forever. Another key concept is using fluctuations wisely. Market movements are not enemies. They are tools. They provide chances to buy low and sell high, but only if used correctly. The intelligent investor waits for favorable conditions. He acts when there is a clear advantage. Another important lesson is emotional stability. The investor must remain steady. He should not become too excited during gains. He should not become too fearful during losses. This stability improves decision-making. Another idea is long-term perspective. Daily price movements are often meaningless. They do not reflect the true value of a business. The intelligent investor focuses on long-term performance. He does not react to short-term noise. This keeps him focused. Another key concept is margin of safety in fluctuations. Price declines can create a margin of safety. If you buy at a lower price, your risk decreases. This improves your chances of success. The intelligent investor looks for these situations. Another lesson is avoiding constant monitoring. Watching the market all the time can increase stress. It can lead to unnecessary actions. The intelligent investor does not need to follow every movement. He reviews his investments periodically. This keeps his mind clear. Another important idea is control. The market cannot control your decisions unless you allow it. You have the choice to act or not act. This control is powerful. Most investors forget this. They feel forced to react. The intelligent investor remembers that he is in control. Another key lesson is discipline during extremes. During strong bull markets, it is easy to become greedy. During deep bear markets, it is easy to become fearful. The intelligent investor remains balanced. He does not follow extreme emotions. Another concept is opportunity and pessimism. When the market is pessimistic, prices may be low. This creates opportunities. But it requires courage to act. The intelligent investor develops this courage through knowledge and discipline. Another idea is avoiding speculation during fluctuations. Short-term movements attract speculators. They try to profit from quick changes. This is risky and unpredictable. The intelligent investor avoids this behavior. He focuses on value, not short-term movement. Another key lesson is consistency. The investor follows the same principles regardless of market conditions. He does not change his approach based on emotions. This consistency creates stability. Another important concept is trust in process. The intelligent investor trusts his method. He knows that over time, discipline will lead to results. This trust helps him stay calm during fluctuations. This chapter teaches a powerful way of thinking. The market is not something to fear. It is not something to follow blindly. It is something to use wisely. Fluctuations are not problems, audiobook. They are opportunities, but only for those who remain disciplined. The intelligent investor sees the market clearly. He does not get influenced by its moods. He acts only when it benefits him. This approach transforms the way he invests. It gives him confidence, it gives him control. And over time, this control leads to better decisions. Better decisions lead to better results. This is the true advantage of the intelligent investor. Chapter 9. Investing in investment funds. Not every investor has the time, knowledge, or interest to select individual stocks. Some people want a simpler path, a way to invest without constant analysis. This is where investment funds become useful. Investment funds collect money from many investors. This money is then managed by professionals. They invest in a wide range of stocks or bonds. This creates diversification automatically. Instead of buying a few stocks, you own small parts of many companies. This reduces risk. If one company performs poorly, others can balance the result. For the defensive investor, this simplicity is very attractive. It saves time, it reduces effort. But simplicity does not mean you should be careless. Not all investment funds are equal. Some are well managed. Some are poorly managed. The intelligent investor must choose carefully. There are different types of funds. Some funds invest in stocks. Some invest in bonds. Some invest in a mix of both. Each type has a different purpose. Stock funds focus on growth. They can offer higher returns, but they also carry more risk. Bond funds focus on stability. They provide steady income, but their growth is usually limited. Balanced funds combine both. They aim to provide moderate growth with reduced risk. The intelligent investor selects funds based on his goals. Another important distinction is between active and passive funds. Active funds are managed by professionals who try to outperform the market. They select stocks based on research and judgment. Passive funds follow a simple strategy. They track a market index. They do not try to beat the market. They aim to match its performance. This difference is important. Active funds often have higher costs. They require research, management, and frequent trading. Passive funds usually have lower costs. They follow a fixed strategy. Over time, costs make a big difference. Higher costs reduce your returns. Even small differences in fees can become significant over many years. The intelligent investor pays attention to this. He prefers lower costs when possible. Another important factor is performance. Many investors choose funds based on past returns. They see a fund that performed well and expect it to continue. But this can be misleading. Past performance does not guarantee future results. A fund that performed well in one period may perform poorly in another. The intelligent investor looks beyond short-term results. He studies long-term consistency. He looks at how the fund performed in different market conditions. This gives a better understanding. Another key concept is management quality. The people managing the fund play an important role. Their decisions affect performance. The intelligent investor considers their experience and approach, but he does not rely completely on them. Even skilled managers can make mistakes. Another important idea is diversification within funds. A good fund should hold a wide range of investments. This reduces risk. If a fund is too concentrated, it becomes risky. The intelligent investor prefers funds with broad diversification. Another lesson is avoiding excessive trading within funds. Funds that trade frequently may incur higher costs. These costs reduce returns. The intelligent investor prefers funds with a stable approach. Another key point is understanding what you own. Even when investing through funds, you should know the basic strategy. What kind of assets does the fund hold? What is its goal? This understanding prevents confusion. Another important idea is emotional comfort. Investment funds can reduce stress. You do not need to track individual stocks daily. This helps you stay calm. Calm investors make better decisions. Another concept is realistic expectations. Funds do not guarantee high returns. They provide a convenient way to invest. The intelligent investor does not expect extraordinary performance. He expects reasonable results with lower effort. Another lesson is avoiding frequent switching between funds. Some investors move from one fund to another, chasing better performance. This behavior often leads to poor results. The intelligent investor stays consistent. He chooses carefully and holds patiently. Another key idea is combining funds with individual investments. Some investors prefer a mix. They use funds for stability and diversification. They select a few individual stocks for additional opportunity. This balance can work well. Another important concept is discipline. Even with funds, discipline is required. You must invest regularly. You must stay invested during market fluctuations. The intelligent investor follows a plan. Another lesson is long-term thinking. Funds perform best over long periods. Short-term results can vary. The intelligent investor focuses on long-term growth. Another key point is risk awareness. Funds reduce risk but do not eliminate it. Market declines can still affect them. The investor must be prepared for fluctuations. Another idea is simplicity as strength. Complex strategies are not always better. Simple, well-chosen funds can provide good results. The intelligent investor values clarity. Another important concept is avoiding overconfidence. Just because a fund is professionally managed does not mean it is risk-free. The investor remains cautious. Another lesson is consistency of investment. Regular investing in funds can smooth out market fluctuations. This approach reduces the impact of timing. Another key idea is patience with results. Good performance takes time. The intelligent investor does not judge too quickly. Another concept is independence of decision. Even though funds are managed by professionals, the decision to invest is yours. You must choose wisely. Another important lesson is alignment with goals. The fund you choose should match your financial goals: growth, income, or balance. This alignment improves satisfaction. This chapter shows that investment funds are a practical tool. They simplify investing, they provide diversification, but they still require careful selection. The intelligent investor uses funds wisely. He does not assume they are perfect. He studies them. He understands them. He chooses those that fit his strategy. Because in the end, investing is not about complexity. It is about making smart, disciplined choices. Investment funds can be part of that choice. They can help you stay consistent. They can help you stay diversified. And most importantly, they can help you stay on the path of long-term investing. Chapter 10. The Investor and His Advisors. In the world of investing, many people look for guidance. They seek advice from experts. They listen to analysts, brokers, and financial advisors. This is natural. Investing can feel complex. Markets can seem confusing, but advice, while useful, can also be dangerous if not understood properly. The intelligent investor knows an important truth. No one will care about your money more than you. Advisors can help, but responsibility always remains with you. This chapter explains how to deal with advisors wisely. There are different types of advisors. Some provide general financial planning, some recommend specific investments, some manage your money directly. Each type has a different role. The intelligent investor first understands what kind of help he needs. If you do not understand your own needs, you cannot choose the right advisor. Another important point is trust. Trust is important, but blind trust is dangerous. An advisor may appear confident. He may speak clearly. He may sound convincing. But confidence does not guarantee correctness. The intelligent investor does not accept advice blindly. He asks questions. He seeks clarity. He tries to understand the reasoning behind recommendations. Another key idea is incentives. Not all advisors have the same motivation. Some may earn commissions from selling products. Some may benefit from frequent transactions. This can create conflict of interest. The advisor may recommend what benefits him, not what benefits you. The intelligent investor is aware of this possibility. He asks, why is this advice being given? Understanding incentives helps avoid mistakes. Another important concept is independence. The intelligent investor does not depend completely on advisors. He uses them as a source of information, but he makes his own decisions. This independence protects him. Another lesson is simplicity in advice. Good advice is usually simple and clear. If something sounds too complicated, it may not be necessary. The intelligent investor prefers clarity over complexity. Another key idea is avoiding frequent changes based on advice. Some advisors may recommend constant adjustments. Buy this, sell that. This creates activity. But activity does not always create results. Frequent changes can increase costs. They can also lead to confusion. The intelligent investor avoids unnecessary actions. He focuses on long-term strategy. Another important concept is education. The best advisor is knowledge. The more you understand, the better decisions you make. The intelligent investor continues learning. He does not rely entirely on others. He builds his own understanding. Another lesson is realistic expectations from advisors. Advisors cannot predict the future. They cannot guarantee returns. Anyone who promises certainty should be questioned. The intelligent investor understands that uncertainty is part of investing. Another key idea is choosing the right advisor. A good advisor should be honest. He should be transparent. He should explain things clearly. He should focus on your goals, not his own benefit. The intelligent investor looks for these qualities. Another important point is communication. A good advisor communicates openly. He explains risks as well as opportunities. He does not hide important information. This transparency builds trust. Another concept is long-term alignment. The advisor and investor should have similar goals. If the advisor focuses on short-term gains while you focus on long-term growth, there will be conflict. The intelligent investor ensures alignment. Another lesson is avoiding emotional influence from advisors. Sometimes advisors may react to market movements. They may become optimistic during rising markets. They may become fearful during declines. The intelligent investor does not get influenced by this. He remains steady. Another key idea is cost awareness. Advisors may charge fees. These fees reduce your returns. Even small costs can grow over time. The intelligent investor considers this carefully. He ensures that the value of advice justifies the cost. Another important concept is accountability. The investor must take responsibility for decisions. Blaming advisors does not solve problems. The intelligent investor accepts responsibility. This mindset improves decision-making. Another lesson is avoiding dependence. Some investors become too dependent on advisors. They cannot make decisions without guidance. This creates weakness. The intelligent investor avoids this. He develops confidence in his own judgment. Another key idea is using multiple sources of information. Relying on a single advisor can be limiting. The intelligent investor listens to different perspectives, but he evaluates them carefully. Another concept is avoiding noise. Not all advice is useful. News channels, opinions, and predictions can create confusion. The intelligent investor filters information. He focuses on what truly matters. Another important lesson is patience with advice. Good strategies take time to show results. The intelligent investor does not expect immediate success. He evaluates advice over long periods. Another key point is understanding your own behavior. Even with good advice, poor behavior can lead to bad results. The intelligent investor works on his own discipline. He controls emotions. Another concept is partnership. The relationship between investor and advisor should be cooperative. It should be based on trust and understanding. But it should not remove responsibility. Another lesson is avoiding overconfidence in advisors. Even experienced advisors can make mistakes. The intelligent investor remains cautious. He verifies information. Another key idea is clarity of goals. Before seeking advice, you must know your goals: growth, income, or safety. Clear goals help you evaluate advice properly. Another important concept is long-term focus. The best advice supports long-term success. Short-term predictions are less valuable. The intelligent investor focuses on lasting strategies. Another lesson is discipline in following good advice. Once you choose a sound strategy, you must follow it consistently. Changing frequently reduces effectiveness. This chapter teaches an important balance. Advice can be helpful, but it can also mislead. The intelligent investor uses advice wisely. He listens carefully. He questions intelligently. He decides independently. Because in the end, investing is a personal journey. Advisors can guide you, but they cannot replace your judgment. The intelligent investor understands this clearly. He takes responsibility. He stays informed. And by doing so, he protects himself from common mistakes. This approach creates confidence. It creates control. And it allows the investor to move forward with clarity and discipline. This is how the intelligent investor works with advisors. Chapter 11. Security Analysis for the Lay Investor, General Approach. Investing may seem complicated at first. Many people believe that only experts can analyze stocks. They think it requires advanced knowledge and complex calculations. But the truth is different. The intelligent investor does not need to be an expert. He needs to understand a few basic principles clearly. This chapter explains how a normal investor can analyze securities in a simple and practical way. Security analysis means studying a company before investing in it. It means understanding what you are buying. Without analysis, investing becomes guessing. And guessing leads to mistakes. The intelligent investor avoids guessing. He relies on facts. The first step in analysis is understanding the business. What does the company do? How does it make money? If you cannot understand the business, it is better to avoid it. Clarity is important. The intelligent investor chooses companies that are simple to understand. Another important step is looking at financial strength. A strong company has stable finances. It has manageable debt. It has enough resources to handle difficult situations. Weak financial structure increases risk. The intelligent investor prefers companies that can survive tough times. Another key concept is earnings. Earnings show how much profit a company generates. But 1 year of earnings is not enough. The intelligent investor looks at long-term earnings. He studies performance over many years. This shows consistency. Consistency is more important than short-term growth. Another important factor is assets. Assets represent what the company owns. These can include cash, property, and other resources. Strong assets provide security. If something goes wrong, assets can protect value. The intelligent investor considers this carefully. Another key idea is debt. Debt can help a company grow, but too much debt creates risk. High debt means higher obligations. If earnings decline, the company may struggle. The intelligent investor prefers companies with controlled debt. Another important concept is the relationship between price and value. Price is what you pay. Value is what you get. These two are not always the same. Sometimes stocks are priced too high. Sometimes they are priced too low. The intelligent investor looks for situations where price is below value. This creates a margin of safety. Another key idea is avoiding complexity. Many financial reports can seem complicated, but the intelligent investor focuses on simple indicators: revenue, earnings, debt, and assets. These provide a clear picture. He does not get lost in unnecessary details. Another important lesson is skepticism. Companies may present their results in a positive way. They may highlight strengths and hide weaknesses. The intelligent investor reads carefully. He questions what he sees. He looks for hidden risks. Another key concept is comparing companies. Looking at one company alone is not enough. Comparison provides perspective. It helps you understand whether a company is strong or weak relative to others. The intelligent investor uses comparison to improve judgment. Another idea is stability over excitement. Companies with stable performance are more reliable. Companies with sudden growth may be risky. The intelligent investor prefers stability. Another important concept is dividends. Dividends show that a company generates real profits. They provide income to investors. Regular dividends indicate strength. The intelligent investor values this consistency. Another lesson is avoiding speculation in analysis. Do not base decisions on future hopes alone. Focus on present facts. The future is uncertain. The intelligent investor bases decisions on what is known. Another key idea is long-term perspective. Analysis should focus on long-term potential. Short-term fluctuations are less important. The intelligent investor thinks in years, not days. Another important point is discipline in process. The intelligent investor follows a structured approach. He does not skip steps. He does not rush decisions. This discipline reduces mistakes. Another concept is margin of safety in analysis. Even after careful analysis, uncertainty remains. The intelligent investor protects himself by buying at a reasonable price. This reduces risk. Another lesson is independence. The intelligent investor does not rely only on opinions. He forms his own judgment. This independence strengthens his decisions. Another key idea is avoiding overconfidence. Even good analysis can be wrong. The intelligent investor remains humble. He accepts uncertainty. Another important concept is continuous learning. Analysis improves with experience. The more you study, the better you understand. The intelligent investor keeps learning. Another lesson is focusing on essentials. You do not need to know everything. You need to know what matters most. This keeps analysis practical. Another key idea is patience. Good opportunities do not appear every day. The intelligent investor waits for clear situations. He does not force decisions. Another concept is avoiding emotional influence. Analysis should be logical. Emotions can distort judgment. The intelligent investor separates feelings from facts. Another important lesson is consistency. Applying the same principles over time improves results. The intelligent investor remains consistent. Another key idea is risk awareness. Every investment carries risk. Analysis helps reduce risk, but it cannot eliminate it. The intelligent investor understands this. Another concept is simplicity as strength. Simple analysis is often more reliable than complex methods. The intelligent investor keeps things clear. Another lesson is practicality. Analysis should lead to clear decisions. If it creates confusion, it is not useful. The intelligent investor focuses on practical outcomes. This chapter shows that security analysis is not about being perfect. It is about being reasonable. It is about understanding enough to make informed decisions. The intelligent investor does not try to predict everything. He focuses on what can be known. He studies businesses carefully. He evaluates value. He applies discipline. And by doing so, he reduces mistakes. Over time, this approach leads to better decisions. Better decisions lead to better results. This is how the intelligent investor approaches security analysis. Chapter 12. Things to consider about per-share earnings. When investors look at a company, one of the first things they notice is earnings. Earnings show how much profit a company makes. This seems simple. Higher earnings should mean a better company. But in reality, it is not that simple. Earnings can be misleading. They can be influenced by accounting methods. They can be adjusted. They can even be presented in a way that looks better than reality. The intelligent investor understands this clearly. He does not accept earnings at face value. He studies them carefully. The first important idea is consistency. 1 year of high earnings does not mean much. A company may have a strong year due to temporary factors. This does not guarantee future performance. The intelligent investor looks at earnings over many years. He studies long-term trends. Consistent earnings growth is more reliable than sudden increases. Another key concept is quality of earnings. Not all earnings are equal. Some earnings come from core business operations. These are more reliable. Other earnings may come from one-time events, such as selling assets or special gains. These are not sustainable. The intelligent investor separates these types. He focuses on true operating earnings. Another important idea is accounting adjustments. Companies use accounting rules to report earnings. These rules allow some flexibility. This means earnings can be presented in different ways. The intelligent investor is aware of this. He does not rely only on reported numbers. He looks deeper into financial statements. Another key concept is earnings per share. This measures profit for each share of stock. It is widely used by investors, but it can also be misleading. If a company reduces the number of shares, earnings per share may increase, even if total profit remains the same. This can create a false impression of growth. The intelligent investor understands this effect. He looks at both total earnings and per share earnings. Another important lesson is growth versus stability. Rapid earnings growth may look attractive, but it can be risky. High growth often comes with uncertainty. Stable earnings growth is more reliable. The intelligent investor prefers steady progress. Another key idea is the relationship between earnings and price. Investors often pay more for companies with higher earnings, but sometimes they pay too much. When expectations are very high, even small disappointments can cause price declines. The intelligent investor avoids overpaying. He compares earnings with price carefully. Another concept is cyclicality. Some companies have earnings that rise and fall with economic conditions. These are cyclical businesses. Their earnings may look high during good times, but they may decline during difficult periods. The intelligent investor recognizes this pattern. He does not assume that high earnings will continue. Another important idea is margin of safety in earnings. Because earnings can be uncertain, the investor needs protection. This protection comes from buying at a reasonable price. If the price is low compared to earnings, risk is reduced. Another lesson is avoiding short-term focus. Quarterly earnings reports can create excitement. Prices may rise or fall based on small changes. The intelligent investor does not react to short-term results. He focuses on long-term performance. Another key concept is comparison. Comparing earnings across companies provides perspective. It helps identify strong and weak businesses. The intelligent investor uses comparison to improve decisions. Another important idea is management influence. Management decisions affect earnings. They can improve efficiency. They can also make poor choices. The intelligent investor considers management quality. Another lesson is skepticism toward projections. Companies and analysts often predict future earnings, but these predictions are uncertain. The intelligent investor treats them with caution. He focuses more on past performance and current reality. Another key idea is real earnings versus reported earnings. Reported earnings may include adjustments. Real earnings reflect true business performance. The intelligent investor tries to understand the difference. Another concept is inflation impact. Inflation can affect earnings. It can increase revenues. It can also increase costs. The intelligent investor considers this when analyzing growth. Another important lesson is avoiding emotional reaction to earnings. Strong earnings reports can create excitement. Weak reports can create fear. The intelligent investor remains calm. He evaluates the situation logically. Another key idea is long-term earnings power. The true value of a company depends on its ability to generate earnings over time, not just in one year. The intelligent investor focuses on this long-term power. Another concept is reinvestment of earnings. Companies can use earnings in different ways. They can reinvest in growth. They can pay dividends. The intelligent investor considers how earnings are used. Good use of earnings creates value. Poor use destroys value. Another lesson is avoiding blind reliance on numbers. Numbers are important, but they must be understood in context. The intelligent investor combines numbers with judgment. Another key idea is consistency of analysis. The same principles should be applied to all companies. This creates fairness in comparison. Another concept is patience in evaluating earnings. Trends take time to develop. The intelligent investor does not rush conclusions. Another important lesson is focusing on fundamentals. Earnings are part of a bigger picture. Assets, debt, and business quality also matter. The intelligent investor looks at the complete picture. Another key idea is avoiding overcomplication. Earnings analysis can become complex, but the intelligent investor keeps it simple. He focuses on key factors. This improves clarity. Another concept is discipline in interpretation. Do not interpret earnings in a way that supports your bias. Be objective. The intelligent investor remains honest in analysis. This chapter teaches a critical lesson. Earnings are important, but they are not perfect. They must be understood carefully. The intelligent investor does not get misled by numbers. He studies them with caution. He looks beyond them. He focuses on long-term earning power. Because in the end, true value comes from consistent and reliable earnings over time. Understanding this helps the investor make better decisions, and better decisions lead to long-term success. Chapter 13. A comparison of 4 listed companies. In investing, understanding one company is useful, but comparing companies is even more powerful. Comparison gives perspective. It helps you see strengths and weaknesses more clearly. A company may look strong on its own, but when compared to others, it may not be as impressive. The intelligent investor uses comparison to improve judgment. This chapter shows how comparing companies can lead to better decisions. When you compare companies, you should look at similar businesses. Companies in the same industry face similar conditions. They compete in the same market. This makes comparison meaningful. The first factor to consider is financial strength. A strong company has a solid balance sheet. It has manageable debt. It has sufficient assets. When comparing companies, look at which one is more stable. Stability reduces risk. Another important factor is earnings performance. Look at how earnings have changed over time. Has the company shown consistent growth? Or has it been unstable? Consistency is a sign of reliability. The intelligent investor prefers companies with stable earnings. Another key idea is profit margins. Profit margin shows how much profit a company makes from its revenue. Higher margins indicate efficiency. When comparing companies, see which one uses its resources better. Efficiency often leads to stronger long-term performance. Another important concept is return on capital. This shows how effectively a company uses its capital to generate profits. A higher return indicates better management and stronger performance. The intelligent investor values this measure. Another key factor is dividend record. Companies that pay regular dividends show financial strength. Dividends provide income and indicate stability. When comparing companies, check their dividend history. Consistency matters more than size. Another important idea is growth rate. Growth is important, but it must be reasonable. Very high growth can be risky. It may not be sustainable. The intelligent investor looks for steady and realistic growth. Another key concept is valuation. Price must be compared with value. A strong company may still be a poor investment if the price is too high. When comparing companies, check which one offers better value for the price. This is critical. Another important factor is debt level. High debt increases risk. Companies with lower debt are more stable. The intelligent investor prefers companies with controlled debt. Another key idea is management quality. Management decisions affect performance. Good management uses resources wisely. Poor management can destroy value. While management is difficult to measure, its impact is visible in results. The intelligent investor observes long-term performance to judge management. Another important concept is business model strength. Some businesses are more stable than others. Companies with predictable demand are more reliable. Companies dependent on uncertain conditions are riskier. The intelligent investor considers this when comparing companies. Another lesson is avoiding popularity bias. Some companies are popular, they are widely discussed, they attract attention. But popularity does not guarantee value. The intelligent investor looks beyond popularity. He focuses on fundamentals. Another key idea is consistency across factors. A good company should perform well in multiple areas. Strong earnings, low debt, stable growth. If a company is strong in one area but weak in others, caution is needed. Another important concept is historical performance. Past performance does not guarantee the future, but it provides useful information. A company with a long record of stability is more reliable. The intelligent investor uses history as a guide. Another lesson is identifying weaknesses. Comparison helps reveal problems. A company may have declining earnings, high debt, or poor efficiency. These weaknesses become clearer when compared to others. The intelligent investor avoids companies with serious weaknesses. Another key idea is balance. Do not focus only on one factor. Consider the overall picture. A company may have strong growth but high debt. Another may have moderate growth but strong stability. The intelligent investor evaluates the complete situation. Another important concept is margin of safety in comparison. If two companies are similar, the one with a lower price offers better safety. This reduces risk. The intelligent investor prefers such opportunities. Another lesson is patience in selection. Do not rush to choose. Take time to compare carefully. Good decisions require thoughtful analysis. Another key idea is avoiding emotional attachment. Do not favor a company because you like it. Base your decision on facts. The intelligent investor remains objective. Another concept is learning through comparison. Each comparison improves understanding. You begin to see patterns. You recognize what makes a company strong or weak. This experience improves future decisions. Another important lesson is consistency in criteria. Use the same standards for all companies. This creates fairness. It prevents bias. The intelligent investor follows a consistent method. Another key idea is realistic expectations. No company is perfect. Each has strengths and weaknesses. The intelligent investor looks for overall quality, not perfection. Another concept is long-term perspective. Comparison should focus on long-term potential. Short-term differences are less important. The intelligent investor thinks ahead. Another lesson is avoiding complexity in comparison. You do not need too many factors. Focus on the most important ones. This keeps analysis clear. Another key idea is independence. Do not rely on others' opinions when comparing companies. Form your own judgment. The intelligent investor trusts his analysis. Another important concept is discipline. Follow a structured approach. Do not change criteria based on preference. This improves consistency. Another lesson is risk awareness. Even the best company carries risk. Comparison helps reduce risk but cannot remove it. The intelligent investor understands this. This chapter teaches a powerful method. Comparison reveals truth. It shows differences clearly. It helps identify strength and weakness. The intelligent investor uses this method regularly. He does not choose blindly. He compares carefully. He evaluates logically. This leads to better decisions. Better decisions lead to better results. Because in investing, clarity is power, and comparison is one of the best tools to achieve that clarity. Chapter 14. Stock Selection for the Defensive Investor. The defensive investor follows a simple and disciplined approach. He does not want complexity. He does not want constant decision-making. His goal is safety, stability, and steady growth. When it comes to selecting stocks, this approach becomes very clear. The defensive investor does not try to find the best possible stock. He tries to avoid bad ones. Avoiding mistakes is more important than chasing perfection. The first principle is quality. The defensive investor chooses companies that are strong and reliable. These companies have a long history. They have proven their ability to survive different conditions. They are not new or uncertain. This reduces risk. Large, established companies are usually more stable. They have resources. They have experience. They are less likely to fail suddenly. The defensive investor prefers such companies. The second principle is financial strength. A company should have a solid financial position. It should not have excessive debt. It should have enough assets to support its operations. Strong finances provide protection. In difficult times, weak companies struggle. Strong companies survive. The defensive investor focuses on survival first. The third principle is earnings stability. The company should show consistent earnings over many years. This indicates reliability. Companies with unstable earnings are unpredictable. The defensive investor avoids such uncertainty. He prefers steady performance. The fourth principle is dividend record. A good company often pays regular dividends. This shows that it generates real profits. Dividends also provide income. They are a sign of strength. The defensive investor values this consistency. The fifth principle is moderate growth. The company should grow over time, but growth should be reasonable. Very high growth may be risky. It may not be sustainable. The defensive investor prefers steady progress. The sixth principle is reasonable price. Even a strong company can be a poor investment if the price is too high. Price matters. The defensive investor avoids overpaying. He looks for fair valuation. This creates a margin of safety. Another important idea is diversification. The defensive investor does not rely on a few stocks. He spreads his investments across many companies. This reduces risk. If one company performs poorly, others can balance the result. Diversification creates stability. The investor may hold a number of different stocks, each representing a strong business. Another key concept is simplicity. The defensive investor does not try to analyze everything in detail. He follows clear rules. This keeps decisions practical. Complex strategies increase the chance of mistakes. Simple strategies are easier to follow. Another important lesson is avoiding speculation. Many stocks attract attention because of excitement, new trends, rapid growth stories. These can be risky. The defensive investor avoids such situations. He focuses on proven companies. Another key idea is patience. Good investments take time. Prices may not rise immediately. There may be periods of slow performance. The defensive investor remains patient. He understands that value takes time to be recognized. Another concept is avoiding frequent trading. Buying and selling too often increases costs. It also leads to emotional decisions. The defensive investor holds his investments for the long term. He makes changes only when necessary. Another important lesson is independence. The defensive investor does not follow the crowd. He does not buy because others are buying. He does not sell because others are selling. He follows his own rules. This protects him from market noise. Another key idea is consistency. The defensive investor follows the same principles over time. He does not change his approach based on short-term results. Consistency allows compounding to work. Another concept is risk control. Every decision should consider risk. The goal is not to achieve maximum return. The goal is to achieve reasonable return with low risk. This mindset creates stability. Another lesson is emotional control. Stock prices fluctuate. Even strong companies can decline temporarily. The defensive investor does not panic. He focuses on the business, not the price. This keeps him calm. Another key idea is long-term thinking. Stocks are long-term investments. Short-term movements are less important. The defensive investor thinks in years, not days. This perspective improves decisions. Another concept is margin of safety. The defensive investor always looks for protection. Buying at a reasonable price reduces risk. This creates a safety cushion. Another important lesson is avoiding extremes. Do not invest too much in one company. Do not take excessive risk. Balance is important. The defensive investor maintains this balance. Another key idea is trust in process. The defensive investor follows a proven method. He does not need to constantly search for new strategies. He trusts his approach. This reduces stress. Another concept is clarity. The defensive investor understands what he owns. He knows why he invested. This clarity prevents confusion. Another lesson is discipline in selection. The defensive investor chooses carefully. He does not rush decisions. He evaluates each company based on clear criteria. Another key idea is avoiding overconfidence. Even strong companies can face challenges. The defensive investor remains cautious. He does not assume everything will go perfectly. Another concept is learning over time. Experience improves judgment. The defensive investor learns from his decisions. He becomes better with time. Another important lesson is practicality. Investing does not need to be complicated. Simple, disciplined actions can lead to success. The defensive investor follows this principle. This chapter shows that stock selection can be simple and effective. Focus on quality. Focus on stability. Focus on reasonable price. Avoid unnecessary risk. Follow clear rules. Remain patient and disciplined. The defensive investor does not chase excitement. He builds a strong foundation. And this foundation creates long-term success. Because in investing, safety and discipline often lead to the best results. Chapter 15. Stock Selection for the Enterprising Investor. The enterprising investor takes a different path from the defensive investor. He is willing to put in more effort. He is ready to study, analyze, and think deeply. His goal is to achieve better results than average. But this comes with responsibility. More effort does not always guarantee better outcomes. Without discipline, it can lead to mistakes. This chapter explains how the enterprising investor should select stocks wisely. The first idea is active selection. Unlike the defensive investor, the enterprising investor does not rely only on simple rules. He looks deeper. He searches for opportunities where value is not fully recognized. This requires analysis. He studies companies carefully. He examines financial statements. He understands business models. This deeper understanding gives him an advantage. Another important concept is undervaluation. The enterprising investor looks for stocks that are priced below their true value. This is where opportunity exists. If a company is worth more than its current price, there is potential for gain. But finding such situations is not easy. The market is competitive. Many investors are searching for the same opportunities. The enterprising investor must be patient. He must wait for clear situations. Another key idea is neglected companies. Some companies are ignored by the market. They may not be popular, they may not receive attention, but they may have strong fundamentals. The enterprising investor looks for these hidden opportunities. This is where value often exists. Another important concept is buying in difficult situations. Sometimes companies face temporary problems. Their stock prices may fall, the market may react negatively, but the underlying business may still be strong. The enterprising investor studies such cases carefully. If the problem is temporary, it may create an opportunity, but this requires careful judgment. Not all problems are temporary. Some are permanent. The investor must be able to distinguish between the two. Another key idea is special situations. Certain events can create opportunities. Company restructuring, changes in management, corporate actions. These events may lead to mispricing. The enterprising investor studies them closely. He looks for situations where the market has not fully understood the impact. Another concept is margin of safety. Even when identifying opportunities, risk remains. The enterprising investor protects himself by buying at a price below value. This reduces the chance of loss. Another important idea is selectivity. The enterprising investor does not invest in everything. He chooses carefully. He focuses on the best opportunities. This improves overall results. Another key lesson is discipline in buying. Do not rush. Wait for the right price. Even a good company can be a bad investment at a high price. The enterprising investor waits patiently. Another concept is discipline in selling. Knowing when to sell is important. The enterprising investor sells when the price reaches fair value. He also sells when his original reasoning is no longer valid. This keeps his portfolio strong. Another important idea is independence. The enterprising investor does not follow the crowd. He forms his own opinions. He acts based on analysis, not popularity. This independence creates opportunity. Another key concept is continuous learning. Markets change, businesses evolve. The enterprising investor keeps learning. He improves his understanding. This helps him adapt. Another lesson is risk awareness. Higher returns often involve higher risk. The enterprising investor manages this risk carefully. He does not take unnecessary chances. Another idea is emotional control. Opportunities often appear during uncertain times. When others are fearful, prices may be low, but fear can prevent action. The enterprising investor controls his emotions. He acts based on logic. Another concept is long-term perspective. Even though the enterprising investor is active, he focuses on long-term value. Short-term movements are less important. This keeps his strategy stable. Another important lesson is effort and reward balance. More effort can lead to better results, but only if applied correctly. The enterprising investor uses effort wisely. Another key idea is avoiding overconfidence. Success can create confidence, but too much confidence can lead to mistakes. The enterprising investor remains humble. He respects the market. Another concept is diversification with focus. The enterprising investor may hold fewer stocks than the defensive investor, but each investment is chosen carefully. He balances focus with diversification. Another important lesson is patience in results. Even good investments take time to perform. The enterprising investor remains patient. He does not expect immediate success. Another key idea is process consistency. The enterprising investor follows a structured approach. He does not change methods frequently. Consistency improves results. Another concept is understanding limitations. No one can find every opportunity. The enterprising investor accepts this. He focuses on what he understands. This reduces mistakes. Another lesson is avoiding unnecessary complexity. Even with deeper analysis, simplicity remains important. The enterprising investor focuses on key factors. This keeps decisions clear. Another key idea is discipline in opportunity selection. Not every opportunity is worth taking. The enterprising investor chooses carefully. This improves quality of decisions. Another concept is balancing caution and action. Too much caution leads to missed opportunities. Too much action leads to mistakes. The enterprising investor maintains balance. Another important lesson is learning from experience. Each decision provides insight. The enterprising investor reflects and improves. This continuous improvement strengthens his approach. This chapter shows that stock selection for the enterprising investor requires effort and discipline. It is not about luck. It is about careful analysis, patience, independent thinking. The enterprising investor avoids poor choices. He selects strong opportunities. This combination creates an advantage. Because in investing, success comes from both avoiding mistakes and making good decisions. The enterprising investor follows this path. And over time, this path can lead to superior results. Chapter 16. Convertible Issues and Warrants. As investors move deeper into the market, they come across different types of securities. Not all investments are simple stocks or bonds. Some instruments are more complex. Convertible issues and warrants are examples of such instruments. At first, they may appear attractive. They seem to offer the best of both worlds, but they also carry hidden risks. The intelligent investor approaches them with caution. A convertible security is usually a bond or preferred stock that can be converted into common stock later. This means you start as a lender or preferred holder, but you have the option to become an owner of the company. This feature seems appealing. It offers stability through fixed income, and it offers potential growth through conversion. But this combination is not always as strong as it appears. Another instrument is a warrant. A warrant gives the holder the right to buy shares at a specific price in the future. It is similar to an option. If the stock price rises above the specified price, the warrant becomes valuable. If not, it may become worthless. These instruments attract investors because of their potential upside. But the intelligent investor looks beyond potential. He focuses on reality. The first important idea is complexity. Convertible issues and warrants are more complicated than common stocks. They involve additional conditions. Conversion terms. Time limits. Understanding these details requires effort. If you do not fully understand them, it is better to avoid them. The intelligent investor prefers clarity. Another key concept is pricing. These instruments are often priced in a way that benefits the issuer. Companies design them to attract investors. But this does not always mean they are good investments. The intelligent investor evaluates whether the price is reasonable. Another important idea is dilution. When convertible securities are converted into common stock, the number of shares increases. This can reduce the value of existing shares. This effect is called dilution. The intelligent investor considers this impact carefully. Another key lesson is risk versus reward. Convertible securities may offer limited downside and some upside, but often they do not provide the full benefit of either stocks or bonds. They may have lower returns than stocks and less safety than bonds. This middle position may not always be ideal. Another concept is interest rate sensitivity. Convertible bonds still behave like bonds in many ways. When interest rates change, their value can be affected. The intelligent investor understands these dynamics. Another important idea is market behavior. During strong markets, convertibles may rise because of their stock component. During weak markets, they may fall because of both stock and bond pressures. This can create unexpected outcomes. The intelligent investor does not assume stability. Another key lesson is avoiding attraction to features. Just because an investment has additional features does not make it better. Complexity can hide risk. The intelligent investor focuses on fundamentals. Another concept is comparison. Before investing in a convertible security, compare it with common stock and bonds. Ask which option offers better value. Often simpler instruments may be more attractive. Another important idea is margin of safety. As with all investments, protection is essential. The intelligent investor looks for a margin of safety. If the price does not provide sufficient protection, he avoids the investment. Another key lesson is avoiding speculation. Warrants, in particular, can be highly speculative. Their value depends on future price movements. This makes them unpredictable. The intelligent investor avoids excessive speculation. Another concept is time factor. Warrants have limited life. If the expected price movement does not happen within that time, they expire without value. This creates additional risk. The intelligent investor considers this carefully. Another important idea is understanding purpose. Why is the company issuing these instruments? Often, companies use them to raise capital under favorable terms. This may benefit the company more than the investor. The intelligent investor remains aware of this. Another key lesson is avoiding overconfidence in complex investments. Complex instruments may create an illusion of sophistication, but they do not guarantee better results. The intelligent investor remains grounded. Another concept is simplicity as strength. Simple investments are easier to understand. They are easier to evaluate. This reduces mistakes. The intelligent investor prefers simplicity whenever possible. Another important idea is selective use. Convertible issues and warrants are not always bad. In some cases, they may offer value, but these cases are rare. The intelligent investor selects carefully. He does not invest in them frequently. Another key lesson is discipline. Do not invest just because something appears attractive. Analyze carefully. The intelligent investor follows a structured approach. Another concept is long-term perspective. Short-term gains from complex instruments can be tempting, but they often involve higher risk. The intelligent investor focuses on long-term value. Another important idea is avoiding emotional attraction. Special features can create excitement, but excitement can lead to poor decisions. The intelligent investor remains calm. Another key lesson is understanding limitations. No investment is perfect. Convertible securities have limitations. Recognizing them is important. Another concept is risk control. Before investing, consider worst-case scenarios. What happens if the stock does not perform? What happens if conditions change? The intelligent investor prepares for these possibilities. Another important idea is independence. Do not invest because others are investing. Make your own decision. The intelligent investor thinks independently. Another key lesson is continuous learning. Understanding complex instruments improves with experience, but caution remains essential. The intelligent investor keeps learning. This chapter teaches a clear message. Not all investments are simple. Some are complex and require deeper understanding. Convertible issues and warrants may appear attractive, but they carry hidden risks. The intelligent investor approaches them with caution. He prefers clarity over complexity. He focuses on value and safety. Because in the end, successful investing is not about chasing every opportunity. It is about choosing the right ones carefully. And often, the simplest choices are the best. Chapter 17. 4 Extremely Instructive Case Histories. In investing, theory is important. Principles are important. But nothing teaches better than real examples. Case histories show how companies behave in real situations. They reveal mistakes. They reveal risks. They show what can go wrong. The intelligent investor studies these cases carefully because real stories create real understanding. This chapter presents lessons from companies that faced serious problems. At first, many of these companies appeared strong. They had good reputation. They showed growth. Investors trusted them. But over time, problems appeared. These problems were not always sudden. Often there were warning signs. But many investors ignored them. This is an important lesson. The first idea is that appearances can be misleading. A company may look strong on the surface. It may report good earnings. It may have positive news. But deeper analysis may reveal weaknesses. The intelligent investor looks beyond surface appearance. He studies fundamentals carefully. Another key lesson is financial weakness. Some companies expand too quickly. They take on too much debt. They try to grow faster than they can handle. This creates risk. When conditions change, these companies struggle. The intelligent investor watches for excessive debt. He avoids companies that grow without stability. Another important idea is management behavior. Management decisions play a crucial role. Some managers take unnecessary risks. Some focus on short-term results. These actions can harm the company. The intelligent investor observes management through results. Consistent and responsible management creates stability. Poor decisions create problems. Another key concept is overexpansion. Companies sometimes try to grow too fast. They enter new markets. They take on large projects. This can create pressure. If growth does not meet expectations, the company suffers. The intelligent investor prefers controlled growth. Another lesson is accounting practices. Some companies use accounting methods to make results look better. They may hide problems. They may delay recognition of losses. This creates a false picture. The intelligent investor remains cautious. He does not rely only on reported numbers. Another important idea is market optimism. When a company is performing well, investors become optimistic. They ignore risks. They believe growth will continue forever. This leads to high prices, but reality can change quickly. The intelligent investor avoids excessive optimism. Another key lesson is sudden decline. When problems appear, prices can fall rapidly. Investors who were optimistic become fearful. They sell quickly. This creates sharp declines. The intelligent investor understands this pattern. He prepares for it. Another concept is lack of diversification. Some investors concentrate too much in one company. When that company fails, losses are severe. The intelligent investor diversifies. He spreads risk. Another important lesson is ignoring warning signs. Problems rarely appear suddenly without signals. There are often early indications. Declining earnings, increasing debt, operational issues. The intelligent investor pays attention to these signs. Another key idea is emotional attachment. Investors may become attached to a company. They believe in its story. They ignore negative information. This leads to poor decisions. The intelligent investor remains objective. He bases decisions on facts. Another concept is timing of recognition. Sometimes problems are visible early, but the market does not react immediately. When recognition comes, it may be too late. The intelligent investor acts before problems become obvious. Another important lesson is risk of popularity. Popular companies attract attention. They may be widely recommended. But popularity does not guarantee safety. The intelligent investor looks beyond popularity. Another key idea is margin of safety. Case histories show that unexpected problems can occur. The margin of safety protects against these surprises. Buying at a reasonable price reduces risk. Another concept is learning from others' mistakes. Each case history provides insight. It shows what went wrong. The intelligent investor uses this knowledge. He avoids repeating the same mistakes. Another important lesson is humility. Even experienced investors can make errors. The intelligent investor accepts this. He remains cautious. Another key idea is discipline in analysis. Careful analysis can reveal risks early. The intelligent investor follows a structured approach. He does not skip steps. Another concept is resilience. Some companies recover from problems, others do not. The intelligent investor evaluates whether recovery is possible. Another lesson is avoiding blind trust. Do not trust a company simply because it has a good reputation. Reputation can change. The intelligent investor verifies facts. Another important idea is long-term consequences. Short-term success does not guarantee long-term stability. The intelligent investor focuses on sustainability. Another key lesson is independence of thinking. Do not rely on public opinion. Think independently. The intelligent investor forms his own judgment. Another concept is patience and observation. Watching a company over time reveals patterns. The intelligent investor does not rush decisions. Another important lesson is risk awareness. Every investment carries risk. Case histories remind us of this. The intelligent investor remains aware of potential problems. Another key idea is preparation. Unexpected events can occur. The intelligent investor prepares for uncertainty. This reduces impact of negative outcomes. Another concept is consistency in principles. The same rules apply in all situations. The intelligent investor remains consistent. This chapter teaches powerful lessons through real examples. It shows that even strong companies can face problems. It shows that mistakes can be costly. But it also shows that careful analysis and discipline can reduce risk. The intelligent investor learns from these cases. He becomes more aware. He becomes more cautious. He improves his judgment. Because in investing, experience is a great teacher. And learning from others' experience is even more valuable. By studying these lessons, the intelligent investor avoids common traps. He protects his capital, and he moves closer to long-term success. Chapter 18. A comparison of 8 pairs of companies. In investing, comparison is one of the most powerful tools. It allows you to see differences clearly. It helps you understand what makes a company strong or weak. This chapter takes the idea of comparison even further. Instead of comparing just a few companies, it looks at multiple pairs. Each pair shows a contrast. One company may appear strong, the other may appear weak. But sometimes the reality is not what it seems. The intelligent investor studies these comparisons carefully because they reveal important lessons. The first idea is that similar companies can have very different results. Two companies may operate in the same industry, they may sell similar products, but their performance can be very different. This difference often comes from management decisions. Strong management creates efficiency. Poor management creates problems. The intelligent investor looks beyond industry. He focuses on individual company quality. Another key lesson is valuation differences. Two companies may have similar performance, but one may be priced much higher than the other. This creates an important question. Which one offers better value? The intelligent investor does not automatically choose the more popular company. He looks at price relative to value. Another important idea is hidden weaknesses. A company may appear strong based on surface numbers, but deeper analysis may reveal problems. High debt, declining margins, poor capital allocation. Comparison helps reveal these weaknesses. The intelligent investor uses comparison to uncover hidden risks. Another key concept is overvaluation. Some companies become highly valued due to popularity. Investors expect strong growth. They are willing to pay high prices, but high expectations increase risk. If the company fails to meet expectations, the price can fall sharply. The intelligent investor avoids overpaying. Another lesson is undervaluation. Some companies are ignored by the market. They may not be popular, but they may have strong fundamentals. These companies may offer better value. The intelligent investor looks for such opportunities. Another important idea is growth versus stability. Some companies show rapid growth. Others grow slowly but steadily. Rapid growth can be attractive, but it often comes with risk. Stable growth may seem less exciting, but it is more reliable. The intelligent investor balances these factors. Another key concept is earnings quality. Not all earnings are equal. Some companies generate strong and consistent earnings. Others show irregular results. Comparison helps identify quality. The intelligent investor prefers consistent earnings. Another lesson is financial structure. Companies with strong balance sheets are more stable. Those with high debt are more vulnerable. Comparison highlights these differences. The intelligent investor prefers financial strength. Another important idea is market perception. The market may favor one company over another. This perception can influence prices, but perception is not always accurate. The intelligent investor looks beyond perception. He focuses on facts. Another key concept is long-term performance. Short-term results can be misleading. A company may perform well for a short period, but long-term performance reveals true strength. The intelligent investor studies long-term trends. Another lesson is margin of safety. When comparing companies, the one with a lower price relative to value offers more protection. This reduces risk. The intelligent investor prefers such situations. Another important idea is consistency across factors. A strong company performs well in multiple areas: earnings, financial strength, and growth. If a company is strong in one area but weak in others, caution is needed. The intelligent investor looks for overall quality. Another key concept is avoiding bias. Do not favor a company because it is well known. Do not reject a company because it is less popular. Comparison helps remove bias. The intelligent investor remains objective. Another lesson is learning from contrasts. Each pair of companies teaches something. It shows what works and what does not. The intelligent investor learns from these contrasts. Another important idea is decision clarity. Comparison simplifies decisions. It helps identify better options. The intelligent investor uses comparison to make clearer choices. Another key concept is discipline in evaluation. Use the same criteria for all companies. This creates fairness. The intelligent investor follows consistent standards. Another lesson is avoiding complexity. Comparison does not need to be complicated. Focus on key factors. This keeps analysis practical. Another important idea is independence. The intelligent investor forms his own conclusions. He does not rely on others' opinions. Comparison supports independent thinking. Another key concept is patience. Take time to compare carefully. Do not rush decisions. The intelligent investor waits for clarity. Another lesson is risk awareness. Even the better company carries risk. Comparison reduces risk but does not eliminate it. The intelligent investor remains cautious. Another important idea is adaptability. Different situations require different judgments. The intelligent investor adapts while following core principles. Another key concept is understanding patterns. Over time, comparison reveals patterns. You begin to recognize strong characteristics. This improves decision-making. Another lesson is avoiding emotional influence. Do not let feelings affect comparison. Focus on facts. The intelligent investor remains rational. Another important idea is balance. Do not focus on one factor alone. Consider the complete picture. The intelligent investor evaluates all aspects. Another key concept is continuous improvement. Each comparison improves understanding. The intelligent investor becomes better with experience. This chapter shows that comparison is a powerful method. It reveals differences clearly. It improves judgment. It helps identify value and risk. The intelligent investor uses this method regularly. He compares carefully. He evaluates logically. This leads to better decisions. Better decisions lead to better results. Because in investing, clarity and discipline are essential, and comparison is one of the best ways to achieve both. Chapter 19. Shareholders and Management's Dividends Policy. When you invest in a company, you become a shareholder. This means you are a part owner of the business. But the company is not run by shareholders directly. It is managed by executives and directors. This creates an important relationship. The relationship between shareholders and management. The intelligent investor understands this relationship clearly because it affects the success of the investment. The first important idea is alignment of interests. Management should act in the best interest of shareholders. They should make decisions that increase long-term value. But this is not always the case. Sometimes management may focus on their own benefits. They may prioritize short-term results. They may take actions that do not serve shareholders. The intelligent investor is aware of this possibility. He evaluates how management behaves. Another key concept is honesty and transparency. Good management communicates clearly. They provide accurate information. They do not hide problems. This builds trust. The intelligent investor values transparency. Another important idea is capital allocation. Companies generate profits. These profits can be used in different ways. They can be reinvested in the business. They can be used to reduce debt. They can be paid as dividends. How management uses profits is very important. Good decisions create value. Poor decisions destroy value. The intelligent investor observes these choices carefully. Another key lesson is dividend policy. Dividends are payments made to shareholders. They represent a direct return on investment. Some companies pay regular dividends. Others retain earnings for growth. Both approaches can be valid, but they must be used wisely. The intelligent investor evaluates dividend policy carefully. Regular dividends indicate financial strength. They show that the company generates consistent profits. They also provide income to investors. This can be attractive for those seeking stability. Another important idea is consistency in dividends. A company that maintains or increases dividends over time shows reliability. Frequent changes in dividends may indicate instability. The intelligent investor prefers consistency. Another key concept is payout ratio. This shows how much of the company's earnings are paid as dividends. If the payout is too high, the company may not retain enough for growth. If it is too low, shareholders may not receive fair returns. The intelligent investor looks for balance. Another lesson is reinvestment of earnings. Some companies do not pay dividends. Instead, they reinvest profits into the business. If this reinvestment creates growth, it can benefit shareholders. But if it is done poorly, it destroys value. The intelligent investor evaluates how effectively earnings are used. Another important idea is management discipline. Good management does not waste resources. They invest carefully. They avoid unnecessary risks. The intelligent investor values disciplined management. Another key concept is shareholder rights. Shareholders should have a voice in important decisions. This includes voting on key matters. The intelligent investor pays attention to governance. Strong governance protects shareholder interests. Another lesson is avoiding blind trust in management. Even well-known managers can make mistakes. The intelligent investor verifies actions through results. He does not rely only on reputation. Another important idea is long-term focus. Management should think long-term. Short-term decisions may create temporary success, but they may harm future growth. The intelligent investor prefers companies with long-term vision. Another key concept is executive compensation. How management is paid can influence their behavior. If compensation is linked to short-term performance, decisions may focus on immediate results. If it is linked to long-term value, decisions are more balanced. The intelligent investor considers this factor. Another lesson is communication during difficult times. Strong management remains transparent even during challenges. They explain problems clearly. They take responsibility. This builds trust. The intelligent investor values such behavior. Another important idea is dividend stability during downturns. Companies that maintain dividends during difficult periods show strength. They demonstrate resilience. The intelligent investor prefers such companies. Another key concept is avoiding excessive dividends. Sometimes companies pay high dividends to attract investors, but this may not be sustainable. If earnings decline, dividends may be reduced. The intelligent investor avoids such situations. Another lesson is balancing growth and income. Some investors prefer income through dividends. Others prefer growth through reinvestment. The intelligent investor understands his own goals. He chooses companies accordingly. Another important idea is accountability. Management should be accountable for their decisions. They should be responsible for results. The intelligent investor looks for this accountability. Another key concept is independence of board members. A strong board provides oversight. It ensures that management acts in shareholder interest. The intelligent investor considers governance structure. Another lesson is avoiding emotional attachment to management. Do not invest just because you like the leadership. Focus on performance and results. The intelligent investor remains objective. Another important idea is consistency in policy. Frequent changes in strategy or dividend policy may indicate instability. The intelligent investor prefers consistency. Another key concept is risk management by leadership. Good management prepares for uncertainty. They maintain financial strength. They avoid excessive risk. The intelligent investor values this approach. Another lesson is learning from management history. Past actions provide insight into future behavior. The intelligent investor studies management track record. Another important idea is independence of investor judgment. Do not rely entirely on management statements. Analyze independently. The intelligent investor forms his own conclusions. This chapter teaches that investing is not only about numbers, it is also about people. Management decisions shape the future of a company. Dividends reflect how profits are shared. The intelligent investor studies both carefully. He evaluates management quality. He understands dividend policy. He looks for alignment with his goals. Because in the end, a good business with poor management can become a bad investment. And a strong relationship between shareholders and management creates long-term value. This understanding helps the intelligent investor make better decisions. And better decisions lead to lasting success. Chapter 20. Margin of safety as the central concept of investment. This chapter presents the most important idea in investing. Everything discussed before leads to this single concept. Margin of safety. It is simple to understand, but powerful in practice. The margin of safety means buying an investment at a price below its true value. This difference creates protection. If your estimate of value is not perfect, the lower price provides a cushion. This reduces risk. The intelligent investor always looks for this protection. Because in investing, certainty does not exist. No analysis is perfect. No prediction is guaranteed. Mistakes can happen. Unexpected events can occur. The margin of safety protects you from these uncertainties. The first important idea is uncertainty. The future cannot be predicted with complete accuracy. Economic conditions change. Businesses face challenges. Even strong companies can experience difficulties. The intelligent investor accepts this reality. He does not rely on perfect predictions. He relies on protection. Another key concept is value versus price. Value is what a business is truly worth. Price is what you pay for it. These two are often different. Sometimes price is higher than value. Sometimes it is lower. The intelligent investor looks for situations where price is lower than value. This creates a margin of safety. Another important idea is conservative estimation. When estimating value, the intelligent investor is cautious. He does not assume the best case. He considers realistic conditions. This prevents overestimation. Another key lesson is avoiding overpaying. Paying too much reduces margin of safety. Even a good company can become a poor investment if bought at a high price. The intelligent investor remains disciplined. He does not chase high prices. Another concept is Protection against errors. Analysis can be wrong. Assumptions may not hold true. The margin of safety reduces the impact of these errors. It acts as a buffer. Another important idea is protection against market fluctuations. Prices can change quickly. Market sentiment can shift. The margin of safety provides stability during such movements. Another key lesson is risk reduction. The goal is not to eliminate risk completely. That is impossible. The goal is to reduce risk to a reasonable level. The margin of safety helps achieve this. Another concept is long-term success. Investing is a long-term process. Small advantages, repeated over time, create large results. The margin of safety improves the probability of success. Another important idea is discipline. The margin of safety requires patience. Opportunities do not appear every day. The intelligent investor waits for the right price. He does not compromise. Another key lesson is avoiding speculation. Speculation often ignores margin of safety. It relies on future price increases. This increases risk. The intelligent investor avoids such behavior. Another concept is diversification and margin of safety. Diversification spreads risk across investments. Margin of safety reduces risk within each investment. Together, they create strong protection. Another important idea is emotional control. Without margin of safety, investors become more sensitive to price changes. Small declines create fear. With margin of safety, the investor feels more secure. This improves decision-making. Another key lesson is independence of thinking. The market may offer high prices during optimism. It may offer low prices during pessimism. The intelligent investor acts based on value, not emotion. Margin of safety guides his decisions. Another concept is patience in buying. Do not buy just because you want to invest. Wait for favorable conditions. The intelligent investor exercises patience. Another important idea is margin of safety in different investments. In stocks, it comes from buying below intrinsic value. In bonds, it comes from strong financial position of the issuer. In all cases, the principle remains the same. Protection first. Another key lesson is avoiding thin margins. A small margin of safety may not be enough. Unexpected events can eliminate it quickly. The intelligent investor prefers a sufficient margin. Another concept is learning from experience. Over time, investors understand the importance of protection. Mistakes often occur when margin of safety is ignored. The intelligent investor learns from these lessons. Another important idea is realistic expectations. Margin of safety does not guarantee success. It improves probability. This understanding keeps expectations balanced. Another key lesson is consistency. Applying margin of safety in every decision creates discipline. This consistency leads to better results. Another concept is avoiding overconfidence. Confidence can lead to ignoring risks. The intelligent investor remains cautious. He always seeks protection. Another important idea is simplicity. Margin of safety is a simple concept, but it is often ignored because of excitement and speculation. The intelligent investor respects simplicity. Another key lesson is focus on downside risk. Many investors focus on potential gains. The intelligent investor focuses on potential losses. By reducing losses, he improves long-term results. Another concept is compounding with safety. When losses are controlled, gains can compound effectively. This creates steady growth. Another important idea is decision clarity. Margin of safety provides a clear standard. If the price does not offer protection, do not invest. This simplifies decisions. Another key lesson is discipline in selling. When the margin of safety disappears, the investment becomes riskier. The intelligent investor considers selling in such situations. Another concept is adaptability. Different situations require different levels of margin of safety. The intelligent investor adjusts based on risk. Another important idea is long-term mindset. Margin of safety works best over time. It protects against short-term uncertainty. The intelligent investor remains patient. This chapter concludes the central philosophy of investing. Margin of safety is not just a technique. It is a way of thinking. It shapes every decision. It protects against mistakes. It reduces risk. It improves results. The intelligent investor relies on this principle. He does not seek perfection. He seeks protection. Because in investing, avoiding large losses is more important than achieving large gains. And margin of safety is the tool that makes this possible. By applying this principle consistently, the intelligent investor builds a strong foundation, a foundation that can withstand uncertainty, a foundation that leads to long-term success. This is the final and most important lesson. The margin of safety is the heart of intelligent investing.